Streaming. Okay, so thank you everyone for joining. My goal for today is really just to uh, look at how the last few years have led us here, how inflation in the economy is affecting both the housing market and mortgage rates, and the role that the media is playing in some of the misinformation that I'm seeing. I'll cover why we're facing such a shortage in housing right now and what we can expect if we see home values and mortgage rates and how they're going to move if we enter a recession. So in my opinion, the opportunity to buy a home for most people is right now while rates are still elevated, as well as the best strategies to use and why it's so important to make sure you're working with the right team. So thank you for giving me a little bit of time today, and I'm going to do my best to make it sure that you feel like it's well spent. Okay, so how did we get here? So the rise we've seen in mortgage rates in the last year has 100% to do with the rise in inflation. The definition of inflation, let's see here, I'm trying to, there we go. The camera is blocking a little bit of my screen. So the definition of inflation is the rate of increase in prices over time. So what we've all seen, prices go up certainly over the last couple of years, from everything from groceries to cars and housing. So essentially, inflation is too many dollars chasing after too few goods. So the pandemic created high inflation since we were all at home with few ways to spend money. Savings rates went up, stimulus checks came in the mail. And then once we were all released and could venture outside again, the supply chain issues created a shortage of goods since there was all this newly unleashed demand. So the end result was that prices on just about everything went up quickly. You may be wondering, what does inflation have to do with mortgage rates? Inflation is the arch enemy of mortgage bonds because it erodes the buying power of a fixed return. So the higher the rate of inflation in the economy, the higher mortgage rates are. A perfect example is going to be the late 70s and early 80s, where we had inflation that was much higher than what we're seeing now, and mortgage rates again were higher. And that was really the only time in history that they were double digit. So the Federal Reserve is all over the media, and what they control is monetary policy. So the Fed only has one tool. They can raise rates and they can lower rates for the Fed funds rate. And in times of high inflation, their only tool to bring down inflation is to raise interest rates. So what they control is called the Fed funds rate, and that will have a direct impact on credit cards, car loans, business loans, home equity lines, and other short-term loans. The Fed does not directly control mortgage rates, despite what the media would have us all believe. For example, the Fed has raised rates 1.75% over the last 3 months, but mortgage rates have actually moved down about 1.5% over the last 3 months. So they are moving in completely different directions at this point. So the Fed's goal is to bring down inflation. Their actions seem to be working. They, ever since kind of November, we've started to see this inflation reports churn. Instead of moving higher, it's moving lower. And that's brought down interest rates. So, things are moving in the right direction. So here's a chart that shows us the relationship between inflation and mortgage rates. So you can see inflation, that's the pink line here at the bottom, measured by the consumer price index. And mortgage rates are measured by the blue line as a 30-year fixed average mortgage. So we can see how they follow each other. So throughout history, as inflation moves higher, mortgage rates move higher, inflation moves lower, mortgage rates move lower. And that's been the case except during the pandemic. So during the pandemic, the Fed had a quantitative easing program, or also known as QE. So that's this entire period from right when it started in February, March through January of 2022. So it went on for 2 years. During that time period, the Fed was trying to make rates really, really low to help keep the economy alive and sustained and stimulated. They were buying about $100 billion a month of mortgage bonds and treasury bonds, which kept rates around 3%. during that entire time period at historical lows. So even though we can see here in the spring of 21, inflation started to move up very quickly. Remember, that's when we all had the stimulus money and we could go out again. Mortgage rates remained artificially low during that time period. They did not spike up to meet inflation. Once they stopped the QE buying, the buying of all those bonds, the stimulus, at that point, we saw mortgage rates shoot up right away to match that inflation curve. So last year, we saw interest rates go from 3 to about 7.5. The good news again is that, as we're recording this today, rates are around 6%. So they've started moving lower very quickly just over the last few weeks. So I'm not a big fan of the media, but I wanted to touch on the role that the media is having in what I believe is a huge misinformation crisis in our country. So the media gets paid by clicks. The more negative the news, the more clicks, the more money they make, right? So if we look at these media headlines, we can see that they've been calling for doom and gloom in a housing bubble bursting for 7 years. I like to say they've kind of incorrectly called the last 7 of the last 0 housing crashes. So if we look at this chart, we can see that in 2015, the average home in the US was 315,000. Okay. And you look at these media headlines, so a bubble larger than 2006, we're in a new housing bubble. It's better to rent than it is to buy. If someone was ready, willing, and able to buy a home during that time, but they held back and continued renting because they were scared based on media headlines, they would have lost out on $222,000 of appreciation. Being that home equity is the number one asset for most people in our country, that's a lot of wealth creation that did not happen if someone didn't buy a home. So with the shortage of homes that we have today and the number of people looking to buy, I believe the future is going to look very similar to that. So here's another example of media scaring us with headlines. So this would cause a lot of confusion between people that are either considering buying their first home or maybe want to sell and upgrade or downgrade, but they are feeling kind of frozen right now. So, when you read these headlines, it is scary, but it's because they never tell us the full story. So here's what you don't see printed anywhere. Yes, foreclosures were up 150% from 2021 to 2022. That's because for 2020 and 2021, due to the CARES Act and the pandemic, banks actually were unable to foreclose. So the foreclosures were the lowest levels ever in history. They did forbearance programs, but an actual foreclosure was prohibited during most of those 2 years. So yes, they went up from 21 to 22. They went from, as we can see here, 65,000 up to 164,000. So no mention in the article that, these last 3 years were the lowest levels of foreclosures ever in history, nor that during the true housing bubble, foreclosures were 10 times what they are right now. So why are foreclosures so low? That can be explained with just 2 words: home equity. So in the 5 years leading up to 2008, no one was buying a home with a down payment. I've been a lender since 2002, so I saw this play out. Even people that had plenty of money to put down 20% or 3% or whatever they needed, that they would be putting down today, no one was putting money down. So that means that if someone in the neighborhood got relocated for their job, they had to come out of pocket to pay, real estate fees to sell the house. So that led to a short sales and foreclosures, which dropped values and created a vicious cycles of values actually moving lower. So if we fast forward to today and look at this graphic on the right here, this came out at the end of 2022. CoreLogic, that does a lot of data studies in real estate, said that the average American has almost $300,000 of equity in their current house. Compare that to almost 0 in 2008, right? So imagine you own a home, you lost your job, you ran out of savings, there was no forbearance opportunities, there was no family that could help. What would you do? right? That's the question. And if it was me, I would call my real estate agent and I'd sell my house because I would want to unlock that $300,000 of equity. Even if you have to discount the price to do a very quick sale, that's not even needed today because there's so much demand. But I would then take the 300, put it in the bank, go rent someplace, and figure out the next chapter of my life. I don't think that any homeowner today would just give the keys back to the bank because that would mean giving up all their home equity and the bank would get to keep that. So the media should not be comparing the current market to 2008 and scaring the public with fears of tidal waves of foreclosures on the horizon, because the market is completely different, mostly due to the home equity position that most people have. So I speak to clients daily, and and some of them are thinking, I'm just going to wait for prices to come down. This is all about supply and demand. So let's take a closer look, because this data on these two graphs tells me that prices are not going to come down in any meaningful way. There's just too much demand and not enough supply of homes. So the top left graph shows national inventory of homes for sale. We can see over the past 40 years, the average, at any given time, there's about 2.5 million homes for sale in the country. During the pandemic years, 2008, it reached almost 4 million homes for sale. And currently, there's about 700,000 homes for sale. So we are well below, we're at a third of average, and well below, the type of market where we could see, too many homes on the market, which would lead to prices dropping. So the bottom right graph shows household formation. So let me define a household for you. So my wife and I live in our home, and we have 3 kids. They're all little, so we are one household. Once they grow up and move out, whether they're rent or buy, they need to live someplace, and that eventually we will become 4 households. Okay, so household formation in 2007 was about 116 million. In 2021 was 130 million. It was about 125 million last year. I blame that on interest rates moving up so quickly that a lot of people that were maybe going to move out from mom and dad's house decided maybe this is not the best time. So, in essence, at the end of the day, we have today 14 million more households than there were in 2008, fighting over 3 million less homes for sale. So as we look ahead into the future and ponder future demands for home, what's important to keep in mind is that nationally there are still over 30 million millennials who do not own a home yet. Eventually, they're going to want to buy a house. You combine that with the fact that, Denver, as an example, is a very desirable place to live, and remote work is possible now after the pandemic with so many industries. So I believe that the shortage of homes is not going anywhere, and therefore home prices will be supported and continue higher. Instead of excess homes for sale, like in 2008, we actually have, our reality is very low inventory and high demand. So what's causing this low inventory? So this, really, we have to go back 33 years and look at birth rates from 33 years ago to come to the conclusion here. So this graph shows household formation compared to new home completion. So household formations are the blue lines, and new home completions, which is when like a builder completes a brand new home and sells it, are the gold line. So if we look back at 2006, builders were completing about 2 million homes per year. At the same time, there was a big drop off in household formation. This gave us a situation where we had a very high supply of homes for sale, but a big drop in buyer demand. When we look at homes for sale in 2006 and buyer demand, it's a dramatic difference. So in 2023, builders are a little more cautious. They're building about 1.4 million homes this year. At the same time, there's a large jump in household formation expected in 2023. And we can see that household formation has outpaced supply for many years now. Okay, so that's why we have this short supply, lots of demands. And again, that's going to push homes higher and support values. So to find the answer, we have to go back 33 years. So this is US birth rates. So this is kind of interesting to look at. So the change in household formation can be used using this chart here. So historically, the average first-time home buyer is 33 years old. We can see a big drop-off in births in 1973 here. These are people that would have turned 33 in 2006 when we saw that big drop-off in new household formation. So that makes sense. There's a lot less people turning 33 in 2006 because there was a big drop-off in people born in 1973. We can also see that 1990, as a coincidence here, or as a contrast, hospital delivery rooms were very, very busy, leading up to 1990, 91, 92. And so that's going to create a lot of 33-year-olds, looking for homes here shortly. So we have a large wave of buyers wanting to buy a home over the next few years. This will increase the demand of homes even more than it is now. And we know that housing inventory is low, so this will support and drive up home prices from these levels. Okay, so some media headlines here are making it sound like values are dropping. So here's a chart of national home price appreciation for the last decade. We had a 10-year stretch where values went up a lot, and 40% just over the last several years. So we have seen at the end of last year, the end of 22, 2 to 3% drop in prices from the peak of summer 2022. Hardly a crash when we would really put it in perspective. I would like to think of it more of as that cooling off period because the market was so overheated last year that people were bidding up home prices 10%, and covering appraisal gap, bidding them up 15 or even 20% for the most desirable homes. And so, yes, there was a little drop off. And, when rates crossed above 6 and 7%, buyers, I can tell you from experience and working with buyers at the end of last year, everybody was just a little more hesitant, really kind of burned out from the previous couple of years and how hard they had to compete, everything short of, signing away their firstborn to get an offer accepted because there was so many offers. So that's, in my opinion, that if this chart was extended a little bit right now, I am already in the first quarter of 2023, we're seeing multiple offers on almost every house. And as rates continue to move lower, that's going to increase further. So I like this chart because if the US housing market was a prize fighting boxer, you would never bet against them. They have a 73-7-1 record. It's actually the third best boxing record of all time. So since 1941, there were 73 years of positive appreciation, 7 years where prices dropped, and 1 year, 1955, with no appreciation. So 2 years that houses dropped, it was 1% and 0% in the early 1990s. So that's really negligible. The rest of the 5 years were during the housing bubble. And I think that, we kind of covered why that was such a different market at that time, but I'll get to a little bit more data in just a bit. So I also like this chart because it shows us that just because there was some high appreciation years, it does not mean that we're due for a drop in prices. That is what the media is that's the message that they're pushing, a fear that, prices are going to drop. So if we look at high inflation periods, so like right after World War II, 1944, 5, 6, 7, there was 17, 20% appreciation year after year. That happened again in the late 70s, high inflation years. But right after that, there was no price drops. Things cooled down to more historical appreciation levels, but there was no price drop. So having several years in a row like we've had of high appreciation is not something that automatically means home prices are going to move lower. And all the data with supply and demand tell me that that's not going to happen. So would it surprise you to know that 8 of the last 9 recessions, home prices remain stable or moved higher? So these dark shaded areas are recessions. This goes back to 1960. Okay, so earlier we saw that during those housing bubble years of 2008, which was the only recession where prices dropped. There was way too many homes for sale, not enough buyers. You couple that with the toxic mortgages that were being done prior to that, zero down payment, no income verification, no employment verification, 100% financing, 125% financing. So banks would loan you more than the house was even worth. Okay, we all know how that ended. So why does housing traditionally do so well during recessions? It has to do with demand from buyers. And to understand that, we need to look at unemployment during recessions and mortgage rates during recessions. So a typical recession sees unemployment rates go up 1 to 2%. Okay, so that means that 2 to 3 million people will likely lose their jobs if we enter a recession at this point. That's bad news, of course, and we feel for them. On the flip side, though, mortgage rates move lower during recessions. And for every 1% drop in interest rates, about 5 million more people qualify to buy a home. They may not all choose to buy a home. Some will continue renting, but it's generally enough to overcome the shortage of buyers that are perhaps losing a job. So lower rates increase affordability. They bring in more people that want to buy, and that helps, again, continue to support home prices and push them higher still. I talk to home buyers daily that think, I'm just going to wait for rates to move back to normal levels. So would you be surprised to know that the average 30-year fixed over the last 40 years was 7.76%? So that is significantly higher. Even at the peak of last year, when it peaked just above 7%, they were still not near this level. Since then, with inflation moving lower, again, as I said, rates are down to around 6% as I'm recording this. So we already know that from last fall to now, there could be 5 million more people that could be out there looking at homes. So we can see that during every recession, which are the shaded parts, interest rates move lower. Okay, so that is a historical fact. Every single recession, we see mortgage rates move lower. So there's a lot of economic science currently pointing to a recession ahead, layoffs from large companies, a lot of tech companies, credit card balances are at all-time highs. So we can expect that rates will move lower into the next year as we enter a recession. So that may sound like a possible reason to hold off from buying and just wait till rates move a little bit lower. But remember that competition is going to move up quickly once rates move lower, and then it becomes harder. You have to bid up the price and do crazy things, waive inspections. If economists are saying we may see a 2% rate drop, so we already went from 7 to 6, and some are saying we could see 5% even before the end of this year, we know that will bring a lot more buyers into the equation. Competition will push higher, and it's going to make it more challenging, especially for someone who does not have a large down payment to buy a house. So I believe, again, that the opportunities to buy are now before rates drop further. And at Zenith, we offer free refinances for past clients for life. So just because you buy with a 6% rate now or a 7% rate, 3 months ago, doesn't mean that you're going to keep that mortgage forever. We track that for you. And as soon as it makes sense to do a refinance and save some money, we can do that. So here's the opportunities that we're seeing now. So the biggest opportunity to increase affordability, which is that affordability has been the biggest issue, right? When you are thinking of when your friends bought a house with a 3% mortgage rate and you are faced with a 7% or a 6% mortgage rate, how to make that payment comfortable and affordable, that's the biggest challenge. So you can use a seller credit right now to create a lower payment for the first 1, 2, or 3 years. This is called a temporary buy down. The most popular buy down strategy has been the 2-1 buy down. This gives you a 2% reduction in interest rate for 12 months, then a 1% reduction for the next 12 months, and then year 3 through 30, it goes back to the fixed rate. So let me, if we rewind time here, and show you column one of this analysis. This is what it was like to buy a home in the spring of 2022. Okay, if a home was listed for 550, you were not even considered as in the equation or in the picture of offers, because homes are getting so many offers. You were not even considered unless you bid up the price at least 10%. So 10, 15, 20% is what we were seeing. You couldn't just bid up the price, and you had to tell the seller up front as part of your offer that you would be willing to cover that appraisal gap. So if the home did not appraise at 600, you would make up that difference. You had an extra $50,000 laying around that you would be willing to throw into the pot to get the deal done. Okay, so in this case, the home was listed at 550, you offered 600, you put down 20% in this example. 480 would be your loan amount. The rate last spring was about 4.5%, and that gave you a $2,700 payment. Okay, with about $126,000 due at closing. If you bought the same home now, and I built this chart, this is how quickly rates are moving about 2 weeks ago. So the rate was 6.5, today it's about 6%. But if you bought a 550 home, you didn't have to bid it up to 600. You had to bid it up maybe to 550, maybe 555, something smaller like that. And you could perhaps ask the seller to give you a $10,000 seller credit to do a 2-1 buy down. So instead of paying 6.5, you paid 4.5 for the first year. That gave you a payment that was $2,500, and you need about $10,000 less the day of closing. Year two, it would go automatically to 5.5, which would give you a $2,800 payment. And then year three, it would go to 6.5. But because of what we're seeing in the economy, the common understanding is that we're doing this to make the home more affordable the first couple of years, but you may not even keep this loan a year, because if we got to a point where it made sense to refinance at, let's say 5%, we would trigger that refinance. Now you have a $2,600 payment instead of $2,700. So you're actually end up with a lower payment by buying at a higher rate without having to bid up the home. And again, less money due the day of closing, right? Only $116,000 instead of $126,000. I like to say, I can always fix your mortgage. Mortgage rates are cyclical. Okay, so it's not forever. But I cannot fix that you last year had to borrow $480,000 to buy the house, and today you have to borrow $440,000. So I can't fix bringing $40,000, $50,000 extra to closing. If it doesn't appraise, those things cannot be fixed. So I think as rates drop, that competition will continue. Certainly, as we're doing this webinar today, I ran numbers for 5 clients this morning who are looking at making offers. Every single home is in a multiple offer situation already. So I think the window of getting a big seller concession is probably closing quickly in the Denver market. But again, that's still a lot better than having to bid up the price, $50,000, $60,000, $70,000. So if you are thinking, should I buy or should I rent, we can help with the rent versus own analysis. So just reach out. This will compare everything side by side over time, not just day one, but over a 5-10 year time horizon. We use conservative appreciation numbers and show you really a big picture view. So I believe that someone that is in a position to buy will cost less at the end of the day to buy now and refinance later, rather than wait for rates to drop and then, see that competition increase. So in this example that I built for a client recently, they were looking at buying a $400,000 home, and they were trying to compare, a $2,900 rent payment that they're paying versus a $3,400 house payment. Okay, so at first you're like, well, that's more expensive to buy. If we look at an annual rent increase of 4%, in 9 years, that rent's going to be $4,000. You would have spent $370,000 on rent, okay, by doing that. This also shows us, whoops, there we go, shows us appreciation. So if we use a very, historical tame and appreciation rate, that $400,000 home is going to be worth $600,000 in 9 years. They would have paid down the loan $47,000, and so have a dramatic increase in wealth, creation for this family. Even after you take out, real estate commissions to sell, you look at the tax benefits, it's a win-win. So that's pretty much what I have for today. Are there any questions that I can help with? It looks like I have one in the chat. Yeah, of course, glad to help. No issues at all. Any other questions?